Today, we're going to talk about 40-year mortgages. It is a product that is not usually discussed by the lenders, but it is out there. And today, I wanted to bring it to your attention so that maybe we can leverage this product to help ease up the affordability issue that we're experiencing today, especially if you live in the areas where properties cost $1 million and over, like in New York City or Massachusetts. If you're in the market for a real estate piece and you want to be able to enjoy flexible payments at a lower monthly rate, this is the video for you. And so what we're gonna do right now is to jump straight into this article right here, courtesy of Rocket Mortgage. And what I want to do is to jump straight into the key takeaways. Please keep an open mind as I'm going through this article, because you might hear some conflicting, not opinions, but some of the numbers might seem a little conflictive, and but it will all make sense at the end. So let's get into it. And what are some of the key takeaways? So a 40-year mortgage is one with a 40-year loan term. The majority of us are used to seeing mortgages that are 30 years long, sometimes even 15, but 40-year mortgage are products that you really have to work hard to find them, right? And so the beauty of this product is that because you're stretching the loan for the life of 40 years as opposed to 30, it could help with a payment affordability by bringing your monthly payments a little bit lower. The only downside of this is that because you're stretching the loan for an additional 10 years, that means that you will end up paying more in interest. But that doesn't always have to be your case if you understand the product that you're using and you have a plan to pay off the mortgage faster. This product can work out for primary residence, and it could also work out for investment properties. You just have to know where to ask. Typically, the best way to find these type of products is by working with a mortgage broker, not directly with the lender, because a mortgage broker has more of a network within his power team, and he will know exactly where to go for this type of product according to your financial situation, right? And so because of this, the 40-year mortgages are considered non-QM loans, meaning that they don't fall within the protection of certain laws, and eventually we'll get into it. And so the lenders will have more flexibility in terms of how they want to structure this. So sometimes you can find a 40-year mortgage with rates that are fixed. Sometimes you can find them with rates that are adjustable. And sometimes you might face loans that are interest only, or that you eventually have to have a balloon payment at the end. And we're going to get into all the details. So what exactly is a 40-year mortgage, right? So it's considered a non-qualified loan, meaning that it doesn't meet the criteria of the Consumer Financial Protection Bureau. And they are in charge of, coming up with certain guidelines and restrictions to protect the consumer in this case. So like certain fees might not exceed a certain percentage of the loan, or like certain rates might not be above a certain amount of points. And so when you are working with a 40-year mortgage, you are outside of those guidelines, and thus it gives the lender more flexibility to decide how they want to structure that loan for you. So in a way, because you're stretching the loan for a longer period, 40-year mortgages are viewed more risky, because it's not the same for me to loan you $1,000 and you pay me back in 30 days versus you paying me back the same $1,000 in 30 years or 40 years. The longer I have to wait for that money to come back to me, the bigger the risk of you not paying me back. That's at least that's how the banks perceive that. And so because of that, 40-year loans also tend to have a higher interest rates because it's also difficult for the lenders to predict inflation in the future and stuff like that. And so let's look at an example, right? So Like I said, because it's a non-conforming loan, these type of products tend to have different ways to package it, for example. So a 40-year mortgage, based on what we're seeing in this article, it can work like a conventional mortgage, meaning that you make a payment on a monthly basis, and then part of that money could go partially to interest and then partially to the reduction of your principal, meaning the reduction of the debt. The first half of that mortgage will most likely go towards interest and very little towards the reduction of your principal. And so that's one way to go about it. But let's look at different examples, right? So let's assume that you're going to buy a more expensive home of $1 million with a jumbo mortgage at 7% interest. So anything that exceeds $1 million, it's called a jumbo mortgage because it's jumbo. It's a large amount that you're requesting. So in this example, we're going to look at 3 numerical examples to kind of like give you an idea of how much interest that we're talking about and how much the monthly payments are going to be and how much you're going to pay in the long run. So if you're going with the traditional 40-year fully amortized conventional fixed rate mortgage, that's like the standard mortgage that everybody knows about, that you pay and then you pay off part of your debt and you pay towards the interest. The payment for principal and interest on a monthly basis, it's going to be $6,214. So when you look at this in the long run for a total of 40 years, you will be paying a total of $1,982,870 in interest. And on top of that, you also have to repay the $1 million that you originally borrowed. So when you add these two amounts, we're talking about something close to $3 million, but not quite hitting the $3 million, right? So that's scenario one. You also could face a different structure. Let's say you can borrow $1 million, but now the loan is interest only. So that means that you will be paying interest for an X amount of time, and then towards the end of that loan, you're going to have to repay the entire debt back with what they call a balloon payment. It's called a balloon payment because think of it as a balloon. It's been blown out together, and we're talking about a big number that you're going to have to repay back. So when you go for an interest-only mortgage, you will notice that the payment goes down to $5,833 compared to $6,214. So in a way, it kind of becomes more affordable, quote unquote, because you're paying less. But then when you look at the whole thing in the long run, you're actually paying more in interest. We're talking about $2,799,998, and on top of that, you also have to pay the $1 million back. So that structure actually puts you closer to $4 million for the very same house that originally cost $1 million. Now you might be thinking, why in the world would someone go with this type of product, just paying interest only and not gaining equity whatsoever? And so this type of structure is actually quite popular for people who are in the flipping business. So you buy real estate, you renovate, you tear walls down, you put a nice kitchen, you add an additional bathroom, and then you sell it. So when you are working with those type of deals, you actually not thinking about, oh, let me just pay down the debt because I want to increase my equity. You're already forcing the appreciation with your renovation, which means you're actually artificially adding equity to your property. So what they want to do at this point is to, keep the monthly payments as low as possible, so that way you can maximize your budget for the renovation. And then towards the end, you will either sell the property and pocket the difference, pay off all the loan, or just simply do a cash out refi, extract the additional equity, and just pay off the old loan. So in that sense, a lot of people tend to want to go, well, not a lot of people, but a lot of flippers, professional flippers, like this type of product because it just makes it more affordable, quote unquote. And at the end, you're still gaining that appreciation, and you can get to, pull the equity one way or the other. The other way you can structure a 40-year mortgage, you will do a hybrid of the two, right? So let's say, for example, for the first 10 years, just like we're seeing in this article, you will be paying interest only. and so you're contributing nothing towards the principal reduction. But then after that 10-year mark, it will convert into a fully amortized mortgage, meaning that whatever payment you make on that point going forward, it's going to help you pay down the principal slowly, but you will also continue to pay towards interest. So as expected, you will save a little bit more on this type of product compared to the interest only. So your monthly mortgage payment will come out to be $6,653 a month, but then overall you'll spend a total of $2,095,000 in interest, and you also have to pay back that $1 million that you originally borrowed. So it puts you a little bit above that $3 million. So now I want to do a side to side, right? Like if I were presented with this scenario, is it's a 40-year mortgage truly worth it, right? Is it really as good as it seems, or is it gonna get you in the long run? So we're comparing these two products side by side, still with a $1 million at a 7% interest rate. And so if you were to go for a 30-year financing, we're talking that your monthly payments are gonna be a little bit higher. I'm actually gonna bring this up a little bit. So it's $6,653. So towards the end of the 30-year, we're talking about a $1,395,089. But if you were to go for the 40-year term, we are seeing here that there's a reduction down to $6,214, which means a reduction of $433 a month. $433 a month, that's groceries for a month, that could be your gas. There's so many things that you can pay with it, right? And but the downside is that because you're stretching the loan for that long, that interest, it's gonna go all the way up to $1,982,870. So at the end of the 40-year, in comparison to a 30-year mortgage, you would pay over $500,000 more for that same mortgage. So the key question will be, is it really that good? Why will someone go for the 40-year term when I can just easily make the sacrifice and go for the 30-year term? So in this case, I'm just gonna see, do you wanted to add something about your opinion and stuff? So, okay, the co-founder is here, but I thought he wanted to say something. So the question is, if you were in my shoes, or if I were in your shoes, presented with a scenario like this, which one would I go with, right? So easily, I will pick the 40-year term, even though it's showing that I'm paying more interest. Why? Because I'm looking for flexibility. Think about this. So I will go for the 40-year term mortgage, but I would treat it as a 30-year, meaning that, yes, I am required by law to pay $6,214. However, I will treat this as a 30-year mortgage, which means that every month I will pay $6,653. And I already did the math. I used the calculator, I punch in all the numbers, picking a 40-year mortgage, it's gonna put me at $6,214, which we saw in this table right here. And if I were to pay an additional $439 into the loan, let's just verify if that's the difference, $439, and I were to make the same payment for the next 30 years, that means the equivalent of 360 months, that means that towards the end, I will still pay off that mortgage in 30 years if I were to make that additional payment. As you see on month 361, I already start with a negative balance, which means that my mortgage has been fully paid off. Do you have to pay $439? That's completely up to you. I'm just saying that if I am going for a 30-year term, I'm going to have more flexibility in the event that something happens. Let's say an emergency, a family emergency, or maybe one of the pipes broke, or maybe the ceiling needs fixing. And so when you have to cover, you know, the added cost of maintenance, sometimes when they come as a surprise, you're going to have to make sacrifices and start cutting costs elsewhere. So what this allows you to do is have a little bit of a breather and say, well, maybe this month and the following month, I don't have to pay the full $6,653. I can choose to pay what is required by law, in this case $6,214, and pocket the difference of $439 so I can cover that emergency, or so that I can pay for the fixing of that pipe that broke over the winter and something like that. And once you kind of like manage to stabilize yourself a little bit, then you can go back to resuming paying your old amount. And like I said, it doesn't have to be 439. Let's say you have the power to pay 500 or 600. The point is, pick the one that requires you the lowest, requires you to pay the lowest monthly payment, but make the effort or make a conscious decision to pay extra towards the mortgage, and you will still wind up enjoying the best of both worlds. You're just planning for any unforeseen circumstances. Now, one of the things about these type of loans that you have to take into account is that these are not found easily everywhere. The reason why lenders don't usually promote 40-year loans is because these are not conforming, meaning these don't fall within the bucket of the products that are protected by law. And so when they're offered to the customer, it can sometimes be perceived as being predatory from the lender side. So you actually have to ask for it. You have to request those type of products, and not all banks will offer it. So if you're in the market looking for a 4-year mortgage to, make it more accessible for you to be able to buy a home or a house for investment purposes, you will have to work with a mortgage broker. The easiest way is by contacting your realtor and then just asking who is the mortgage broker in their network. And trust me, any realtor has a lender in their network. If they don't, then run away, because that means that realtor is not ready to represent you, right? And so that's typically how you can get your hands on it. The only exception where a lender will offer you a 40-year mortgage is if you need to restructure that loan. What do I mean by that? Let's say you bought a house and then something happens, a death in the family, you got fired, or maybe one of the spouses, had a problem and now it's completely disabled and unable to work and generate income, and now the burden is falling onto one person or a few people. And so you will contact the lender and say, what, is there a way to restructure this loan so that way I can continue paying this mortgage because I don't want to lose the house. And believe me, the lenders are going to try to work with you. They're not in the business of taking your home away. It actually costs them more money to keep a property in their books, and it also doesn't make them look good in front of the regulators, because that means they didn't do their due diligence in evaluating the prospect the way they should have. So in a mortgage restructure, what they're going to do is they're going to start looking at your actual income and then figure it out. Hey, how can we stretch this loan further out in a way that you can continue to pay and not lose a roof of your head and have a house for your family, but at the same time that you can make those payments in a comfortable way. And that's when they will possibly propose a 40-year mortgage to help you stretch it out. But even to that point, they will try to explore other possibilities before even offering you a product like that. So for example, let's say if you are unable to make mortgage payments temporarily, one of the possible solutions that they might offer you is a mortgage forbearance, meaning they're gonna pause the mortgage payments temporarily, and then during the time that you're not paying, that will give you a little bit of a breather. And of course, the interest that are accumulating month over month is going to get added back into your mortgage. So you got to be really careful and understand what you're signing, because now you'll be paying interest on top of interest, because again, they get added up to the principal. So that means the loan keeps growing more and more, and you have to pay interest on top of everything. And so just be careful. And another possible solution they might offer you is to, I haven't seen it lately, but during 2008, during the financial crisis, a lot of the debt, part of it was forgiven, and the loans were restructured as well at the newer price, at the updated price of the market. So that's something that could happen if it happens, collectively all across the nation, like it did in 2008. So something for you to keep in mind. And that's all about the 40-year mortgage. It's a great product. Don't be afraid of it. It could seem a little bit more expensive in the long run, but I just share the strategy with you and how you can pay it off faster, so that way you don't have to drown in high interest and pay more than you should for your dream house or for your next investment property. So,
Awesome. Hey everyone, this is Anthony. Hope you're doing great. We have a question from Rick. All right. So the question is this the same as an interest-only loan?
Um, yes and no, Rick. So interest rate only loans can come in 5 years, 10, 15, sometimes even 30. So interest only loans are what you make it to be. So every time you're shopping for mortgages, you can ask, is this fully amortized or is this interest only? It just happens so that part of this 40-year mortgage product, some of them sometimes do come as a 40-year mortgage interest only loan.
One of the other questions that we received before was, is this only for new houses or old houses?
It works for either or. It doesn't have to be a brand new construction. I know that lately a lot of people have been asking, especially if you're in Florida, for brand new constructions because they tend to be a little bit more affordable to maintain, meaning yes, the entry point is a little bit more expensive because they're brand new, then it costs more. However, because they're brand new, they're built to the newest standard, and so that translates to lower insurance costs. So the cost to maintain a house like that is actually cheaper as if you were buying an existing one. But this type of product is available for anything. I think it's more public now because of the issue of affordability. I know that in some markets, some properties are actually coming down in value or stabilizing. Like, I don't necessarily believe or view that they're coming down or like dropping unless you're buying in those condos with those special assessments and stuff. But overall, when you add the high cost of housing with the 7% rate, we're still talking about a big affordability issue. So a lot of people are looking to explore for alternatives, and the 40-year mortgage is actually one of them because you're not really saving money, you're just stretching it out so that way your monthly payments become lower, and that way you can put your hands on the house that you wanted to buy without having to wait any longer. And then if things do change in the future, you always have the option to refinance to a lower rate or to pull equity and just buy more properties. Why not?
All right. So we have another question by Rick. Hey, Rick. I buy
Hello.
rental properties. I'm not sure if banks do it for investment houses.
Like I said, Rick, you do have to ask, and that's usually for it's only specific lenders offer. And the reason why I know this is because we are working very closely with a builder in Florida. We're actually partners with them. Their name is Southern Impression Homes. And so we do have clients and followers that we send their way to look for cash flow investment properties. And so the 40-year mortgage recently hit the market about a month or two ago. And so I was actually copied on that email, and I know that's something that they're offering. Yes, the interests are a little bit higher than a 30-year, for example. But when you look into it, you actually do generate more cash flow. And to add more to that, one of the observations, because when the product was first presented to us, we weren't the ones buying, our student was. But it got me thinking, and I was like, why would he go for a 40-year mortgage? Because you will never build any equity. Like, you're stretching it out for an additional 10 years. So as you're paying it off, like, you have very little chances of building equity. Not impossible, but you're building it very slow. But then I realized, hey, wait a minute, like with all of our investment properties, we haven't held them for more than 5 years. So in essence, what matters is the cash flow that you're getting on a monthly basis. And then if you pick the product, or in this case the house, in the right market, that means that the market appreciation will take care of everything. Not all the markets are going to go up, but in the long run, if you hold it long enough, you will build up some equity in your property, and you can always refinance out of it or sell that to buy something bigger through a 1031, which is what we've been doing. And so we realized that, hey, I wish I knew this product was available sooner, because if anything, it will maximize our cash flow even more, because our strategy was to start small and then slowly build equity and then just sell it and then buy more and bigger properties in nicer areas too. And so, all right.
Thank you. Thank you
Thank
so
you, Ricky.
much,
Yeah,
Rick.
great. Great connecting with you over here.
Yeah. Well, she reads those questions. I'm just going to say thank you so much for looking into and tuning in. If you have any questions, please drop them in the comment section below, and we can answer those
So
questions.
there was another question, from Instagram. So saying, are there any prepayment penalties or any special fees on the 40-year? Yes. So because they're non-conforming, that gives the lender a little bit more creativity because they're not confined to certain rules. So 40-year mortgages do have a prepayment penalty. Not all of them, to my experience, but that's something you need to make sure and you need to ask. And if there is a prepayment penalty, then you should find out how much is it, because sometimes it does make sense to pay the prepayment penalty and move on to a different product or a different property. I have paid prepayment penalties on my commercial loans mainly. If you're under the typical traditional residential loans, there's usually no prepayment penalties, but when you're doing DSCR loans, for example, there's usually, in my experience, a 3% penalty. The longer you wait it out, the lower the prepayment penalty. The sooner you paid it out, then the higher the prepayment penalty. And they're usually within the first 5 years. So if you wait until year 6 to pay it off, then there's usually no prepayment penalty. However, don't quote me on that because those products do change depending on how the market is doing. So what I'm telling you today might not be the case next year or the following year.
Awesome. Any other questions that you guys have, you can put it in the comment section below and we'll see if we can answer those. Anything else?
So insurance and escrow, is there a way to do safe and PMI? Well, to my knowledge, the 40-year mortgage requires you to pay your 20%. Like I haven't seen one and where you can pay less than the usual 20%. If there is a product like that, please do let me know because I would like to get into that and take a look at it as well and see if we can expand our portfolio further. And so I think this is it in terms of what we have to share. Are there any more questions?
Let me double check, and if I have another question, give me 1 second.
And I will see if there's anything else that needs to be covered in this article. I don't think so. I mean, we can go over the pros and cons, but I sort of like talk through them. Yes, the pros is that you get a lower monthly payment, but the downside is that you do pay higher mortgages, higher interest rates. But it doesn't necessarily mean you will pay more over time if you have a strategy on how to pay it down faster. The math winds up doing the same, just like I show you on this article. If you continue to pay, treat it like a 30-year mortgage, you will pay it off by 30 years. You just want the flexibility in the event that you're basically just preparing for the worst. So in terms of alternative, you can consider conventional mortgages, jumbo loans, which is what we got recently for our latest project. It was definitely the most expensive project we have bought today, 1.75 million. And so we had to jump on one of those jumbo loans. It was quite an experience for us. And then you can try going through an FHA loan. I'm not a big fan of FHA loans because they won't allow you to take the PMI out, meaning for the majority of the loans, like if you go for a conventional loan, for example, and you do a low down payment option, let's say 5%, by the time you pay that debt all the way up to you hit 20% of equity, you can actually call the bank and request them to remove the PMI, which is the private mortgage insurance. That insurance is necessary for anything that it's less than 20% down because you're actually insuring the lender for the piece that you didn't put as a down payment. And so with FHA's loans, even though you hit that 20% equity, you will not be able to remove the PMI. You can choose to stay on it and continue to pay the PMI, or just simply refinance and look for another option that doesn't involve the PMI. I think it's a matter of running the numbers, because if your refinance winds up costing you more, then sometimes it's better to just keep biting it and just keep paying the PMI. But if you have the option to remove it and just contribute more towards the principal, then yeah, you should do that instead.
All right. Any other question? If not, that will be it.
Yep. So let us know how you feel about this. I know it's been a while since we've done a live. We were actually trying different things. We're busy with different projects, and we're here to assist you. If you, for whatever reason, you tuned in after the live, feel free to leave questions down in the comment section below, and I'll definitely do my best to reply back with any answers.
All right. Thank you so much, guys, and have an awesome day.
Take care.
Take care.
Bye-bye.
Bye.